Hey everyone, welcome back. If you've been sitting on the sidelines waiting to buy a home, you're probably asking the same questions I hear every day. Is the market going to crash? Should I wait for lower interest rates? Is this really the bottom? And honestly, this market has been confusing. Prices softened, sales slowed, rates came down, but buying still feels hard. So today I'm going to walk you through clear, simple, realistic predictions for 2026. And more importantly, what they actually mean for you if you're thinking about making a move or buying your first home this year. Let's get into it. Prediction number 1, 2026 will be a buyer-leaning market, not a crash or a boom. A lot of people are waiting for a big moment, a huge crash, or a sudden rebound. But the consistent message from economists and market experts is this: the market is in a reset, not a crash, not a boom. And prices have softened, sales are slower, but there's no sign of a dramatic collapse and no sign of a rapid rebound either. In markets like Greater Vancouver, prices peaked a few years ago and have been slowly adjusting ever since. Now, this kind of correction is usually slow, quiet, and drawn out. What this really means for you is you're not going to miss a sudden price surge, and you're also not likely to see a sudden crash. So for the first time in a long time, you actually have something rare in real estate: time. Time to plan instead of panic. Prediction number 2, mortgage renewals will add more homes to the market. Over the next year, over 1 million mortgages are coming up for renewal. Many that were locked in at ultra low rates. Many were paying around 1.5%, sometimes a bit lower. Now they're renewing closer to 4%, maybe 4.5%. That means monthly payments going up significantly. 60% of mortgage holders in Canada are expected to see their payments go up by the end of 2026. That represents a third of all mortgage holders in Canada. So that being said, most homeowners will manage. They'll extend their amortization. They'll tighten budgets. But some will decide, this is too much. This is too expensive. I would rather sell. I'd rather downsize. And some investors will sell properties that no longer make sense to hold. That creates one important thing: more homes for sale, more listings, more choice, more negotiating room. So what this really means for you is that you're likely to see more inventory on the market in 2026. So instead of bidding wars, you'll have time to view homes, time to think and leverage, to add conditions. The power balance is shifting slightly more toward buyers. Prediction number 3, Vancouver condo prices will stay soft. Condos, especially in Vancouver, have been under pressure, and a lot of condos were built. Many were bought by investors. Rents have flattened. Interest costs went way up, and some investors are now losing money each month, and they're also choosing to sell. That keeps the condo supply high and demand lower. Detached homes behave differently though. So for most first-time buyers, condos and townhomes are the entry point. So what this really means for you is if your first home will be a condo, 2026 may offer one of the best buyer environments we've seen in years. More negotiable pricing, more flexible sellers, and fewer bidding wars. But don't expect fast price growth right after you buy. This is about long-term ownership, not quick flips. Prediction number 4, interest rates will stay mostly stable. Many buyers are still waiting for rates to drop a lot, but most forecasts suggest that rates will likely stay close to its current levels in 2026. So variable rates are affected by the Bank of Canada's overnight rate. This currently sits at 2.25% at the time this video is recorded, while variable rates that we're seeing are around the 3.5% mark. While banks typically use the Government of Canada bond yield as a benchmark for the fixed rate mortgage pricing. After a slight increase end of December 2025, this sits roughly just below or above 4%. So there may be small cuts, there may be small increases, but no return to ultra cheap money. And here's an important point. Even after rate cuts last year, home sales stayed weak. That tells us something important. Confidence and job security now matter more than rates alone. So what this really means for you is waiting for a huge rate drop is probably not a winning strategy. Instead, plan your budget based on today's realistic rates. Make sure that your monthly payment feels comfortable, not stretched. In 2026, financial planning beats perfect timing. Prediction number 5, the mortgage stress test will still limit affordability. Even if mortgage rates are around 4%, lenders still make you qualify at a higher rate. So that's the stress test. That was implemented early in 2018 that makes you prove to the banks that you can afford your mortgage if interest rates go up. So this is calculated by using the greater of the Bank of Canada benchmark rate of 5.25% or your negotiated rate plus the 2%. And it's one of the biggest reasons why first-time buyers feel stuck. You might feel ready. You might afford the payment. But if you don't pass a stress test, you don't qualify. So this rule is expected to stay in place as of today, and there's no indication that this will be going away this year. What this really means for you is that you may qualify for less than you expected. So your strategy might include starting with a smaller home, buying a condo first, co-buying with a partner, maybe using family gift funds. Knowing this early on helps you set realistic expectations and avoid disappointment. Prediction number 6, rental markets are softening. So for years, renters felt trapped. Rents keep rising. I need to buy now. But recently, more rental buildings were completed. For example, through 2026-2027, there's expected to be 180,000 purpose-built rental units, increasing the rental supply by 7%. Immigration slowed, and the federal government has already announced lower immigration targets moving forward. And since immigration was one of the biggest demand drivers during the housing boom, slower population growth now means less pressure on housing demand, especially in major cities like Vancouver. Rental construction is at a 10-year high, which has pushed vacancy rates up, especially in major cities like Vancouver and Toronto. As a result, national asking rents have fallen about 3% year over year, and in BC, rents are down roughly 5.5%. In fact, Vancouver renters are seeing the most affordable rental conditions in nearly 4 years, and about 65% of new rental buildings are offering incentives just to fill the units. That tells us rental pressure has eased significantly. Landlords are offering incentives. Renters have more choice. What this really means for you is that renting in 2026 is not failing. It can be a good strategy to save more, build a bigger down payment, and buy later from a stronger position, not from pressure. Prediction number 7, the market bottom will be quiet. Not obvious. Many buyers say, I'll buy at the bottom. But here's the truth. Today, homes are sitting on the market. Prices are barely moving. Buyers are hesitating. Sellers are disengaging. That's the kind of environment we're moving into now. Slow, quiet, and uneventful. What this really means for you is there will not be a flashing sign that says, this is the bottom. So focus instead on when you are financially ready, when you find the right home, and when the payment fits comfortably. Trying to time the bottom often means missing good opportunities. Prediction number 8, new home construction has slowed. Another major trend shaping 2026 is new housing supply. Construction costs are high. Financing is expensive. Buyers are cautious. Multiple Vancouver market analysts pointed out that new condo and townhouse projects are being stalled or delayed or canceled across major cities. A key early warning sign is that Architectural Billing Index, which tracks design contracts for future construction, and it has now recorded 18 consecutive months of decline, the longest downturn in history. When builders stop delivering new supply, future inventory disappears, and that eventually helps stabilize housing markets. Here's where this becomes important. When new housing projects are canceled or delayed, it doesn't hurt the market today. It creates a problem 2 to 5 years from now. Because if fewer homes are being built today, there will be fewer homes available in the future. Exactly when population growth and household formation start picking up again. That's what economists call a future supply shock. It means in the short term, prices stay soft. In the long term, supply tightens again. And historically, when demand returns but supply is limited, prices rise faster than expected. What this really means for you is that if you wait too long to buy, you may eventually face a market where there's less inventory, more competition, and faster price growth. So, while 2026 gives buyers time and leverage, there's also a long-term risk in waiting with no plan. So if you buy with a 10-year mindset, the long-term fundamentals still support ownership. Prediction number 9, immigration has slowed, reducing demand pressure. So as I mentioned earlier, immigration levels have been reduced from recent highs. Canada actually saw a net population decline of about 76,000 people in Q3 2025, and the federal government has begun reducing immigration targets. Fewer newcomers means less new housing demand, less competition in big cities. And what this really means for you is less demand pressure helps keep prices and rents from rising too fast. So this contributes to a more balanced market in 2026. Prediction number 10. Variable rate mortgages may be cheaper, but riskier. So another interesting shift in 2026 is happening with mortgage rates. For the first time in a few years, variable rate mortgages are actually cheaper than fixed rate mortgages. So at the time this video is being recorded, variable rates are sitting roughly between 3.5%, while fixed rates are just hovering around 4%. Now, that might not sound like a big difference, but over a full mortgage, it can mean thousands of dollars in savings. Most forecasts suggest that Bank of Canada will keep rates fairly stable this year. And if that happens, variable rate borrowers will likely pay less interest overall. But, and this is important, if inflation rises again, variable rates can move up. So variable mortgages come with lower starting payments, more flexibility, but more uncertainty. And fixed mortgages come with slightly higher starting payments, but predictable, stable payments. So what this really means for you is there's no one-size-fits-all mortgage in 2026. If you value stability and peace of mind, fixed may feel better. If you handle some movement and want lower starting costs, variable may save you money. So the key is choosing the option that fits your comfort level, not just the lowest rate. Prediction number 11. Government policy focuses on stability, not restarting a boom. Governments are focused on keeping people housed, protecting renters, avoiding financial system risk. They are not planning new policies to spark another housing frenzy. So what this really means for you is don't wait for a government rescue to fix affordability overnight. Your best move is personal financial planning, not hoping for policy changes. Prediction number 12. Job markets have softened. When people feel uncertain about work, they delay big financial decisions. That keeps buyer demand calm. And nationally, Canada's unemployment rate has been elevated, around 6.8% at the end of 2025. And projections suggest that it'll stay near that level through 2026. So that reflects softer hiring, more people searching for work. In BC, rates have hovered in the mid-6% range, and Greater Vancouver's jobless rate has sat around the low 6% range. Some forecasts expect BC unemployment to peak near 6.5% and gradually ease next year. This means that while jobs aren't collapsing, employment conditions are still weaker than pre-pandemic levels, and job confidence will continue to influence housing demand in 2026. What this really means for you is if your job is stable, you're in a strong position. Just make sure to build a safety buffer, avoid overstretching, and plan conservatively. So what's the real message for first-time buyers in 2026? There's more choice, more negotiating power, more time, less panic. But affordability still matters. So success comes from knowing your numbers, planning long-term, and buying when you are ready, not when the crowd is loud. If you have any predictions for this year, I'd love to hear them in the comments. And if you made it this far and you found this video helpful, please like and subscribe so it can reach more people. Thanks so much for watching, and see you on the next video.